Bond investors have done very well over the past 30 years. That's because interest rates have been trending down for most of that period, and bond prices move in the opposite direction of interest rates. But interest rates, which are being kept down to some extent by Federal Reserve policies, can't stay in the gutter forever. And when rates do rise, people who hold bonds will see the value of their investments decline. The losses could be significant. Does that mean you should abandon bonds entirely? Probably not. The main alternatives to bonds, stocks and cash, have their own shortcomings. While stocks have performed fabulously since March of 2009, few people should have 100% of their portfolio in them. The older you are and the more conservative you are, the less you want to have in stocks. The problem with cash investments, things such as money market funds and treasury bills, is that they pay nothing nowadays. Taking into account the impact of inflation, you're actually losing money. If you decide you want to stick with bonds, your first defense is to shorten the maturities of the bonds you hold. The shorter a bond's maturity, the less its price will swing with changes in interest rates. One of the best mutual fund choices in this category is Vanguard Short-Term Investment Grade. Consider too a floating rate bank loan fund. Banks typically extend these loans to companies with subpar credit ratings. Interest rates normally reset every 60 or 90 days. Because of these adjustments, these securities hold up well when rates rise. A fine choice in this area is Fidelity Floating Rate High Income Fund. Finally, look at bond funds that can invest across the entire fixed income universe with little restriction. Some may even have the ability to bet against bonds, that is, invest in such a way that would make money when interest rates rise and bond prices fall. Two Kiplinger favorites are Osterweiss Strategic Income Fund and Metropolitan West Unconstrained Bond Fund.